And for those of you that were at Bothwell, you may recall that we talked about or worked through a scenario with regard to Dad, who's currently aged 67, and he's decided he wants to transfer the farming property to his son under a business succession plan. That property's been continuously farmed, and Dad actually originally acquired the property during 1987 via Granddad's estate, and at the time that Dad acquired it, it had a deemed cost base of $650,000 for capital gains tax purposes. The value's moved on a bit quite significantly, and so the property is currently valued today at the date of the transfer at $2.5 million. So working through the scenario, we've got obviously the deemed transfer consideration, which is the current value of $2.5 million. From that, we're going to subtract the cost base for Dad with $650,000, so that leaves us with a notional capital gain of $1,850,000. Because Dad's held the property since 1987, he's held it for more than 12 months, and so we can apply the capital gains tax 50% discount, so that allows us to reduce that notional gain by $925,000. And again, because the family satisfy the basic conditions for eligibility for the CGT small business concessions, and also because the farming property is actually held and used in a business, it's considered to be an active asset, so we're allowed to also reduce the remaining gain by a further 50%, or in this case $462,500. And then finally, given Dad's age and stage in life and the fact that he hasn't used the concession before, the retirement exemption offers a once-off lifetime limit of $500,000, and so in this case that comfortably takes care of the rest of the taxable capital gain, and we end up with a net taxable capital gain, in this case of nil. And on that basis there's also no capital gains tax payable, so not a bad result. But what if, for example, the Commissioner decides to audit the transaction and he forms the view that Dad wasn't eligible to apply the small business concessions to the transfer? Essentially it's the same scenario, but in this case obviously we end up with a notional capital gain of $1.85 million. Because it's been held for 12 months, we are still allowed to apply the 50% discount, so that reduces the capital gain by $925,000. But because the Commissioners concluded that Dad wasn't eligible to apply the small business concessions, and unfortunately the active asset exemption is out, and so is the retirement exemption. So on this particular revised scenario, we end up with a taxable capital gain of $925,000. So what does that mean from a tax point of view? Well, as we said, we've got the capital gain of $925,000, and we've estimated income tax on that payable at the top marginal rate, which on this particular number is $430,125. There will also generally be a penalty in this sort of scenario, and the penalties can range from 25% of the primary tax payable, where the Commissioner considers that the taxpayer has applied the law wrongly, through to a penalty of about 75% where they think they've been reckless in their application of the law. So in this case we've estimated the penalty at being at the lower end. In this case it's another $107,531. And then, because these things usually take a while to unravel, sometimes up to a couple of years, to get the results of an audit back and get it sorted out and settled, we've also, there's also generally interest payable on the unpaid tax and penalty, which is called general interest charge, and so we've estimated that spanning out for 2 years based on the current general interest charge rate, and so that's another $28,818, which gives us a total estimated liability arising from the audit, in this case of $566,474. So that's a significant liability, particularly where you weren't expecting it, and it's going to leave a significant hole in the farm cash flow for quite a significant period, I'd suggest, and also in the net family wealth. So certainly something we want to avoid, and I guess what that goes to show you is there can be a significant difference in these cases between getting it wrong and getting it right. This is a complex area, and certainly something that you need to look at carefully before you make the decision to apply the concessions. So as we said, this is a bit of a complex area. If you do need more information or you would like assistance, then please don't hesitate to contact us. Thank you very much for watching, and we hope you enjoy the rest of the videos on the page.